What if I told you that one of the most staggering predictions ever made on this channel, a call that some bears laughed at in comments section, is now being chased by the biggest institutions on the planet? Welcome back to Smart Stock Sam, the channel where disciplined research meets real conviction, and where price targets are revealed based on real-time data. Today, we are sitting days away from what could be the most consequential earnings report in the history of modern financial markets. I am talking about Nvidia, ticker NVDA. And before we go 1 second further, I need you to understand something. The April 28th thesis I laid out on this channel, the one that pinned $195 as the absolute line in the sand, didn't just play out. It exploded into a parabolic vertical that pushed Nvidia to a $5.7 trillion market capitalization, made analysts scramble to revise their own targets, and triggered one of the longest winning streaks this stock has seen since 1999. We are going to walk through every single piece of this, from the technical gates that fell, to the trillion-dollar pipeline, to the exact trade setup you need heading into May 20th. And along the way, I want you to ask yourself one question. What happens to a stock that is still technically undervalued at $5 trillion? Stay right here because the answer is going to surprise you. To understand where we are going, we need to look at exactly how we got here. Cast your mind back to May 5th. The market was nervous. NVDA dipped to an intraday low of $196.50. Testing our thesis almost to the dollar. For a moment, the bears thought they had won, and one of them actually pointed by commenting under the video. But if you were watching Smart Stock Sam, you knew that level was not a danger zone. It was a launch pad, and that is precisely what happened. From that $196.50 pivot, Nvidia launched into one of the most aggressive technical breakouts we have ever seen for a company of this big stature. By May 12th, our first major price target of $220 had been neutralized, not approached, not tested, but fully cleared. And by May 14th, the stock surged into what I call the blue sky zone, printing a historic all-time intraday high of $236.54. That move pushed Nvidia's total market capitalization to a staggering $5.7 trillion, making it one of the most valuable companies ever to exist on this planet. Wall Street's 12-month targets of $275 to $300, targets they set with great fanfare at the beginning of the year, were suddenly being chased in real time, just 2 weeks after our call. That is not luck. That is the power of disciplined, data-driven analysis. Now let me show you exactly how that move was structured, because this is where most retail investors miss the architecture of a true institutional breakout. We track this advance through a series of what I call technical gates, pre-identified price levels, where the battle between buyers and sellers reaches a decisive point. Gate 1 was at $207. It fell on May 6th, less than 24 hours after our final support. Gate 2 was at $212. It fell by May 11th. Each gate that fell confirmed not a random move, but a systematic, deliberate institutional accumulation. And here is the detail that makes this remarkable. We recorded an 11-session winning streak, 11 consecutive sessions of positive closes. To put that in historical context, that is the longest winning run for this stock since its market debut back in 1999. What drives something like that? I call it institutional gapping behavior. Big money, we are talking pension funds, sovereign wealth funds, and the largest asset managers on earth, is so desperate for Nvidia exposure that they are buying every single opening bell regardless of the premium they are paying. They are not setting limit orders, they are chasing, and when the biggest money in the world is chasing a stock, retail investors who have been patient and disciplined get to ride that wave from the front. Now I know what some of you are thinking, $5.7 trillion? Sam, that has to be a bubble. I read that in the community discussions, and I want to settle this once and for all with the actual math. Despite the stock price sitting at all-time highs, Nvidia has done something almost no company in history has managed at this scale. It has decoupled from traditional bubble metrics. The most important number in this analysis is the PEG ratio, price to earnings relative to growth. Even at a $5.7 trillion valuation, Nvidia's PEG ratio sits squarely between 0.66 and 0.69. In growth investing, a PEG below 1.0 signals a structurally undervalued company. Read that again. Nvidia, the $5 trillion company, is structurally undervalued by this metric. How? Because the company is projected to grow its revenue by 72% in fiscal year 2027. The earnings are not just keeping up with the stock price, they are outrunning it. The bubble narrative collapses the moment you look at the numbers. But a great valuation means nothing without a business model to back it up, and this is where the margin moat becomes the most powerful competitive weapon in the market. Nvidia is not just selling chips, it is printing software-like profits at hardware scale. Their net margin, the percentage of revenue that survives all expenses and flows to the bottom line, sits at a dominant 55.6%. Let me give you a comparison that will immediately clarify how extraordinary that number is. Advanced Micro Devices, AMD, their primary competitor in the AI chip space, is operating at approximately 20% net margin. Nvidia is running at nearly 3 times the efficiency. That gap is not a slight edge. It is a structural moat. It means Nvidia can absorb geopolitical headwinds, invest in next-generation architecture, and still deliver the kind of fortress balance sheet stability that long-term institutional investors demand. This is why I classify NVDA not as a speculative momentum play, but as a total return investment, combining aggressive hypergrowth with the financial resilience to weather any storm the market throws at it. And speaking of resilience, let us talk about the engine that makes the next 3 years of this story not just possible, but mathematically inevitable. Management has confirmed high-confidence visibility into $1 trillion in cumulative revenue through 2027. I want you to sit with that number, $1 trillion. And this is not speculative pipeline. These are signed, committed contracts for the Blackwell and Vera Rubin architectures. Institutional research notes are describing baseline demand from hyperscalers and sovereign governments as insane. Every major cloud provider, we are talking about the largest technology companies on Earth, and nation-states building their own artificial intelligence infrastructure, are locked into Nvidia's ecosystem. When you have $1 trillion in committed revenue sitting in your order book, a $5 trillion market capitalization starts to look like the starting line, not the finish line. But here is where the story gets geopolitically complicated, and this is the section that I know has been dominating your newsfeed. On May 13th, the market received what appeared to be the ultimate bullish catalyst. Nvidia CEO Jensen Huang joined President Trump on Air Force One for a high-stakes diplomatic trip to Beijing. Almost simultaneously, the United States government formally cleared approximately 10 of China's largest technology firms, including Alibaba and Tencent, to purchase the H200 AI chips. The market interpreted this as the reopening of what had been a $50 billion per year revenue stream that was previously closed off by export restrictions. NVDA surged into that historic high of $236.54. The China discount, the shadow that had been hanging over Nvidia's valuation for 2 years, seemed to vanish in a single afternoon. For 24 hours, the bull case looked complete. And then May 15th happened. President Trump confirmed what the market had chosen not to hear. While the licenses had been granted, not a single order had actually been placed. Chinese technology firms, under pressure from Beijing's national directive to develop domestic artificial intelligence infrastructure, had not pulled the trigger. What appeared to be a reopened revenue channel was, for now, a channel with no water flowing through it. I am calling this the zero-order deadlock, a situation where the legal authorization exists, but the political will to use it does not. The result was a single-session wipeout of $170 billion in market capitalization, a drop of 4.42% in one afternoon. Now, I want to be extremely precise about what this means and what it does not mean. This is a geopolitical deviation. It is not a structural failure of Nvidia's core artificial intelligence thesis. Every hyperscaler in North America, Europe, and Southeast Asia is still ordering at maximum capacity. The demand picture outside of China has not changed by a single dollar. What we lost was the bonus. The baseline remains fully intact. Compounding the May 15th pressure was a shift in the broader macroeconomic environment that every growth investor needs to understand. Hotter than expected April Consumer Price Index and Producer Price Index data essentially erased the market's expectations for Federal Reserve rate cuts for the remainder of 2026. That drove the 10-year Treasury yield up to 4.6%. Why does that matter for Nvidia? Because high interest rates act as gravitational force on high valuation growth stocks. When risk-free yields rise, the discount rate that investors apply to future earnings also rises, compressing valuation multiples. This is not unique to Nvidia. It is the basic mathematics of equity valuation. But here is the critical insight. While retail investors were reading the negative headlines, the smart money was reading the flow data. And the flow data tells a completely different story. Here is the institutional conviction picture as it stands today. 76.64% of Nvidia's shares are held by institutional investors. In early 2026, the Vanguard Group alone increased its Nvidia position by 1,008%. 1,008%. The put-to-call ratio in Nvidia's options market is sitting at 0.37, meaning there are nearly 3 bullish options bets for every single bearish one. Institutions are absorbing every insider sale with zero friction on the bid. And in a detail that has drawn significant public scrutiny, financial disclosures reveal that President Trump himself holds between $1 and $5 million in Nvidia stock, a position whose timing relative to the China export approval decisions has not gone unnoticed on either side of the aisle. The smart money is not panicking, it is positioning for May 20th. So let us talk about what to actually expect when the earnings report drops. The Wall Street consensus is expecting revenue of approximately $78 billion. But the whisper estimate, the number that sophisticated traders are actually pricing in, sits between $80 billion and $81 billion. Here is the historical context. Nvidia has beaten the consensus revenue estimate by more than $1 billion in 9 of the last 12 quarters. A beat and raise is not the optimistic scenario. It is the base case, the floor. Beyond the headline revenue number, there are 3 specific operational metrics I want you to watch like a hawk. First, data center networking growth. This segment surged over 260% last quarter, driven by the NVLink fabric architecture. We need confirmation that this growth trajectory is sustained and accelerating. Second, any update on China guidance. Because China revenue was previously excluded from forward guidance entirely, any positive incremental signal here, even a single committed order, would trigger an immediate institutional re-rating of the stock. Third, the $95.2 billion in supply commitments that are sitting on the books. We need to see evidence that this capacity is being actively deployed at customer sites, not sitting idle. If all 3 metrics confirm, the post-earnings reaction could be historic. From a pure technical standpoint, the May 15th sell-off was not a disaster. It was a gift. The pullback allowed the relative strength index to reset from deeply overbought territory back down to a neutral 47.5. That is the technical equivalent of a race car cooling down its brakes before the final lap. The froth is gone. The daily cup and handle pattern that has been developing for weeks remains fully intact, and that pattern carries a mathematical measured move breakout target of $262. The MACD indicator is still flashing an active buy signal on the daily time frame. The technical setup heading into May 20th could not be cleaner. Here is the trade execution framework for the week of May 18th through May 22nd. Our primary entry zone sits between $222.30 and $225, aligning with the daily S1 support level and key psychological levels. Primary support is at $215, where we see a massive concentration of call open interest acting as a floor. If volatility gets extreme, the stop loss, the level at which the cup and handle pattern is technically invalidated, is at $204, which corresponds to the 200-day moving average. On the upside, expect heavy resistance between $230 and $235 due to call option concentration at those strikes. A clean break above $235 before or after earnings would open the path toward $250 almost immediately. And that brings us to the big picture, what I am calling the gigawatt capacity path. With a $1 trillion committed revenue backlog, 76% institutional ownership, a PEG ratio below 0.7, and the most powerful hardware ecosystem on the planet, our near-term post-earnings baseline target is $250. Looking 12 months forward, the consensus from Wells Fargo, Bank of America, and my own internal model converges on $315 to $320. The question on Nvidia is no longer whether we reach $300, it is how fast the Blackwell and Vera Rubin architecture cycle takes us there. Before I wrap up, I need to share something important. Nothing you have heard in this video is financial advice. Smart Stock Sam is an educational channel. Every analysis, every price target, every trade setup I discuss is for informational and educational purposes only. Markets carry real risk. You can and do lose money. Always do your own research, understand your own risk tolerance, and consult a qualified financial professional before making any investment decision. Past performance, including any calls made on this channel, does not guarantee future results. Invest responsibly. Now here is my final thought. We are standing at what I believe is a generational inflection point in artificial intelligence infrastructure. Nvidia is not just a stock. It is the central nervous system of the AI economy. The May 15th pullback tested conviction, and smart money did not flinch. The earnings print on May 20th is the next major catalyst, and the technical and fundamental setup is as clean as I have ever seen heading into a major event. Stay disciplined, protect your levels. Do not let short-term noise shake you out of a long-term structural position. Now I want to hear from you. Drop a comment below and answer this. If Nvidia delivers $81 billion in revenue and raises guidance above consensus, what do you think the stock does by the end of May? Does it clear $250 before June, or does macro headwinds keep a lid on it? I genuinely want to read every single response. If this breakdown gave you value, hit the like button right now. It takes 1 second and it makes an enormous difference in helping this channel reach more investors who need to see this analysis. If you are not subscribed yet, what are you waiting for? Hit subscribe and turn on notifications so you never miss a Smart Stock Sam update before a major catalyst. And if you really want to support the work we do here, you can send a super thanks directly through YouTube's support feature. Every single one is seen, every single one is appreciated, and it goes directly into making this research deeper and more valuable for all of you. Stay sharp, stay disciplined, and I will see you next time.